Pause for a moment before you blame yourself. Before you assume you must have done something wrong. Before you convince yourself that if you just worked a little harder, saved a little more, everything would eventually work out. Let me ask you a very simple question, one that very few people are willing to ask honestly. Who can actually afford a $500 home in 2026 without quietly destroying their financial life? Not who gets approved for a loan. Not who gets a nod from the bank. But who can buy and still sleep well at night. If you've been staring at your paycheck wondering, did I miss some massive income jump? Or worse, am I falling behind while everyone else seems to be buying homes? Let me say this slowly. The problem isn't you. The problem is the numbers. We're living in a strange moment where housing prices are talked about as if they still follow old rules, while the math behind them has completely changed. People still talk about the American dream. They still say that if you work hard enough, everything will eventually line up. But very few people are willing to sit down and actually do the math. And that's exactly what real estate marketing, mortgage ads, and social pressure don't want you to do. They want you to feel. They don't want you to calculate. This video isn't meant to make you feel hopeful. It isn't meant to scare you either. It's meant to bring clarity. Clarity about what's actually possible, and what's just an illusion kept alive by outdated stories. Clarity about why so many homeowners look successful on the outside, yet live under constant financial stress. And clarity about why the feeling of, I'm just not trying hard enough, is often the result of a system that's no longer balanced. If, while listening, you feel a little lighter, like some of the self-blame has been lifted, that isn't an accident. That's what happens when you start viewing money through the lens of math instead of emotion or comparison. And if you value conversations about money that are calm, honest, and unpolished, consider liking this video. It helps this message reach others who are quietly asking themselves where they went wrong. And if you want to keep building wealth at a quiet, sustainable pace, without rushing, without chasing the crowd, you can subscribe to Quiet Wealth. We're not trying to move fast here. We're trying to go far. Now, let's begin with something very few people are willing to do honestly. Let's do the math. Let's talk about the number $500, slowly and realistically. To many people, $500 still sounds like a large number. It brings to mind the idea of a stable home. Something good enough for a middle-class family. Not luxurious, but safe. Not a fantasy, just the reasonable destination after years of hard work. But that image belongs to the past. In many parts of the US today, $500 doesn't buy space. It doesn't buy comfort, and it certainly doesn't buy financial ease. It buys a starter home, a small house, a little over 1,000 square feet, a modest yard, and everything at the level of acceptable. Not because you're asking for less, but because the market offers no more. And this is where the gap starts to appear. The median U.S. household income is just over $80 a year. That doesn't sound low, but when you place it next to a home priced at 6 times that income, the math starts to feel uncomfortable. Not emotionally uncomfortable, structurally uncomfortable. In the past, buying a home usually meant 3 to 4 times household income. There was room to breathe. Today, we're asking middle-class families to take on an enormous financial commitment from the very beginning. And then we're surprised when they feel anxious, stretched, and constantly behind. But the real shock usually isn't the price. It's the down payment. The old rule is still repeated like a mantra. Put down 20%. It sounds reasonable. On a $500 home, that's $100 in cash. Not borrowed, not promised. Real money. Now place that number next to reality. The average American savings account holds only a few $1,000s. Not because people are lazy. Not because they're reckless. But because the cost of living has quietly eroded the ability to save for years. The gap between $8 and $100 isn't a gap of willpower. It's a gap of financial starting position. And to bridge that gap, the system offers a solution: lower down payments. 5%, 10%. It sounds like the door has just opened. But it comes with a cost very few people fully understand: PMI. PMI is often called mortgage insurance. But let's call it what it really is: a monthly penalty for not being wealthy enough at the start. You pay hundreds of dollars each month, not to protect yourself, but to protect the bank from its own risk. You're not building equity faster. You're not buying security. You're paying for permission to stay in the game. And this is where many people start blaming themselves. They think if they were more disciplined, more willing to sacrifice, if they just pushed a few more years, everything would eventually align. But the truth is, many people are playing the same game, just not from the same starting line. This gap wasn't created by a lack of effort. It was created by asset prices rising faster than income, by living costs increasing before savings could catch up, and by a system that treats long-term financial strain as normal. When you see that clearly, something important happens. You stop asking, "What did I do wrong?" and start asking a more grounded question. Does this game still make sense for me? Before we answer that, we need to take one more step. Because the purchase price is only the doorway. What truly decides everything are the monthly numbers, the ones you live with year after year. Now, set emotions aside. No comparison. No hope. Just numbers. Assume you made it through the first gate. You found a $500 home. You managed a 10% down payment. Not ideal, but enough to start. On paper, it looks workable. The problem is, life doesn't happen on paper. It happens monthly. Let's start with the biggest expense, your mortgage. On a $450 loan at 6 to 7% interest. Principal and interest alone land around $2,800 to $2,900 a month. For many people, that's more than their entire rent. And that's just the beginning. Next comes property tax. In many states, that's easily $500 a month. Not negotiable, not deferrable. It arrives no matter how your income looks that month. Then there's homeowners insurance. Once a small line item, now quietly growing. Wildfires, floods, extreme weather. All of it shows up in premiums. $300 a month is no longer unusual. But homes don't maintain themselves. Roofs age, HVAC systems fail, pipes leak. A conservative financial rule is to set aside about 1% of the home's value per year for maintenance. On a $500 home, that's over $400 a month. Not for upgrades, just to keep things from breaking. And if you didn't put down 20%, there's PMI, about $300 a month. No added value, no direct benefit, just the cost of entering the game with less capital. Now add it all together. Mortgage, taxes, insurance, maintenance, PMI. $4.367 per month. This is where many people say, as long as I can make the payment. But sustainable finance isn't measured by whether you can make the payment. It's measured by how much room you have left to live. Financial planners often recommend keeping housing costs under 28% of gross income. That's considered safe, leaving space for saving, investing, and life surprises. To safely afford $4.367 a month, you'd need about $187 in annual income. Banks are more lenient. They'll approve up to 43%. Under that rule, you only need around $150 a year. The loan gets approved, the contract gets signed, the keys are handed over. But pause here. The bank doesn't live your life. The bank doesn't pay for food, transportation, healthcare, or sleepless nights over bills. The bank only cares whether you can repay the loan, whether you can live calmly, steadily, and with breathing room. That's not part of their equation. And this is the most dangerous misunderstanding of all. Being approved for a loan doesn't mean you can afford the life that comes with it. When housing costs consume too much of your income, everything else becomes fragile. One small disruption, a dip in income, a medical bill, an unexpected repair, and the whole structure starts to shake. Math doesn't care how hard you try. It doesn't reward sacrifice. It simply reflects the structure of the numbers you live with, month after month. And when we look at those numbers honestly, one truth becomes clear. The issue isn't a lack of discipline. The issue is that many people are being invited into financial commitments without enough room to absorb the weight. Before talking about systems or alternatives, we need one more step, from math to real life. Because when these numbers are placed on a real family, they tell a very different story. So let's step away from the spreadsheet. Let's place these numbers into a real household. Call them the Johnson family. Not because they're special, but because they're ordinary. Two adults, both working full-time, a combined income of $160 a year, above the national average. On paper, they're doing well. By social standards, they qualify for a $500 home. After taxes, basic health insurance, and mandatory deductions, they take home about $9,500 a month. That sounds comfortable, until you place it next to housing costs. $4,367. Nearly half of their take-home income disappears into the house. Not because they overspend, not because they live extravagantly, simply because they chose to own a home. That leaves about $5,100. And now real life speaks. 2 cars are nearly unavoidable, not for status, but for work, school, and daily life. Payments, insurance, gas, maintenance, it easily exceeds $1 a month. Then healthcare. Even with insurance, there are copays, prescriptions, unexpected visits, quiet, unannounced, but constant. If they have children, costs rise quietly. Food, clothing, activities, childcare, none of it looks overwhelming alone. Together, it becomes steady pressure. And then come the unplanned moments. A car that won't start. An air conditioner that fails during the hottest week of the year. A repair bill in the thousands. Arriving without warning. These events aren't rare, they're just life. After everything, the Johnsons are left with about $1,500 a month. That has to cover entertainment, gifts, rest, emergency savings, and if possible, investing for the future. This is where the term house poor appears. You own a home. You have an asset. But you don't have freedom. Every decision is filtered through quiet worry. Not panic, just constant tension. There's always a question in the background. What if something happens? The Johnsons aren't living badly. They're living tightly. Tight on money. Tight on options. Tight on room for mistakes. They can't easily change jobs. They can't pause. They can't take small risks for bigger opportunities. Everything must stay safe, because there's no cushion to fall on. And this is important. This isn't a story of irresponsibility. They weren't reckless. They did what society told them to do. They bought a home. They stabilized. They followed the path. The cost was calm. House poor doesn't mean poor in the traditional sense. It means wealth exists on paper. While pressure exists in daily life. You become richer in ownership, but poorer in choice. When many families end up here, the question isn't, who failed? It's, why is this considered normal? Before we end this story, there's one more layer to uncover. The Johnsons didn't end up here by accident. They were guided here, by a system whose incentives don't align with your peace. If all of this leaves you feeling heavy, let me say this clearly. That reaction makes sense. Money isn't just numbers. It's safety. It's the future. It's whether you sleep at night. And when a financial decision causes stress before it even happens, that isn't weakness, it's awareness. Here's the part few people say out loud. The system is designed for you to sign. Banks profit when you borrow. Agents profit when you buy. Sellers benefit when prices rise. There's little incentive to ask whether this decision will give you a calmer life. Meanwhile, home prices have risen faster than income for decades. Math used to balance. Now it doesn't. But the social story hasn't caught up. We're still told that owning a home equals success, maturity, and doing things right. So when you opt out, it's easy to feel behind, even when you're protecting yourself. Quiet wealth sees wealth differently. Wealth isn't owning something that causes monthly anxiety. Wealth is sleeping well without checking your account every night. Wealth is having breathing room to save, to invest, to handle life's surprises. And sometimes, the path to that kind of wealth doesn't begin with buying more. It begins with not buying. Renting isn't failure. It can be strategic, investing the difference, building flexibility, keeping your life from being locked into one obligation. These are valid choices. They aren't flashy. They won't earn applause, but they last. You're allowed to move slowly. You're allowed to say, not yet. And you're absolutely allowed to step away from a game whose rules are no longer fair. Choosing not to play doesn't mean giving up. It may mean you understand the game well enough to protect yourself. If this video helped you feel lighter, if it helped you revisit your financial choices with less self-blame and more calm, You may want to subscribe to Quiet Wealth. We'll continue having these conversations, slow, honest, and focused on long-term peace over short-term pressure. Thank you for listening. Come back when you're ready. We're not in a rush. We're building something meant to last.